Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is August 1st, 2025. I am Luna.
I am JPMorgan.
We had strong tech earnings, but also rising inflation worries and new trade tensions. So let's start with the numbers. Where did things land?
Yeah, cautious is a good word. Looking at stocks, U.S. equities definitely pulled back. The Dow Jones fell about 0.7%, lost over 300 points there, landing at 44,130.98. And the S&P 500 was also down about 0.4%. That's 23 points off to 6,339.39.
Okay, but the Nasdaq, nearly flat, down just 0.03%. That seems a bit counterintuitive, no? I mean, even with giants like Microsoft and Meta posting great earnings, it couldn't lift the whole market.
Right, that's a really important point. It shows how weak the market breadth was. Outside of communication services and parts of tech, most sectors lost ground. Small caps, for example, they were down about 1%. So it was very concentrated strength.
Interesting. And what about the bond market? What were yields doing?
Yields were a bit mixed. The benchmark 10-year Treasury yield kind of hovered around 4.38%. Not much change there. But the 2-year yield, which is more sensitive to Fed policy expectations, that actually ticked up a little to about 3.96%.
And the yield curve is still inverted.
It's still inverted, yeah. Short-term bonds yielding more than long-term ones. That often suggests the market thinks the Fed might have to cut rates down the line because of, well, maybe an economic slowdown, even with inflation being what it is.
Okay. Moving beyond stocks and bonds, commodities, how did things like gold and oil fare?
Well, gold prices firmed up a bit, rose maybe 0.5%. That looks like a classic flight to safety with all the trade uncertainty. But oil pulled back, dropped about 1%, settling near $69.30 a barrel.
Why the drop in oil?
Seems like it was a combination of an unexpected build in crude inventories here in the U.S., plus some caution about those U.S.-Mexico trade rumblings.
Got it. And even crypto seemed to catch that risk-off feeling. Bitcoin fell.
It did, yeah. Bitcoin dropped roughly 2.4%, slipped below the $115,000 mark. It just reflects that broader shift away from riskier assets. And, uncertainty about the Fed always plays a role there, too.
Okay, so let's connect the dots. What were the big macro events really driving these moves? What stood out?
I'd say the biggest news was probably President Trump's executive order on reciprocal tariffs. It imposes these sweeping tariffs, like 10% to 41% on goods from dozens of countries. We're talking 35% on Canada, 50% on Brazil, 25% India, 20% Taiwan. Quite broad. And those are set to kick in pretty soon, August 7th.
Wow, that sounds like a massive deal. But the market reaction felt kind of muted compared to past tariff scares anyway. What's your read on that?
That's the interesting part, isn't it? It's like the market's maybe built up some immunity, or perhaps it priced in a lot of this risk already. Still, it wasn't nothing. It did push the U.S. dollar higher, which is typical in risk-off moves, and it definitely contributed to stock pulling back. Plus, you have the potential inflation impact down the road.
Right, inflation. That brings us to the next point. The June PCE inflation numbers came in hot, didn't they?
They did. The Commerce Department reported the core PCE index, that's the Fed's preferred measure, rose 0.3% in June. And year on year, it's up 2.8%. That's still quite away from the Fed's 2% target. Overall, PCE was 2.6% year on year.
So this really reinforces that higher rates for longer idea.
Absolutely. And consumer spending was resilient too, up 0.3% in June. So if spending holds up and inflation stays sticky, well, it makes it harder for the Fed to justify cutting rates. Some economists are now saying maybe no cuts until October 2025, perhaps even later.
And rounding out the picture, the labor market is still tight.
Very tight. Weekly jobless claims came in around 218,000, basically unchanged, still near historic lows. It shows employers are holding on to workers, which is good for incomes, but it also keeps wage inflation concerns alive for the Fed. Give them less reason to ease up policy.
Okay, so looking ahead, what should we be watching? The July jobs report is out tomorrow, right?
That's the big one tomorrow, yes. Consensus expects the unemployment rate might tick up just slightly, maybe to 4.2% from 4.1%. But really, the key things to watch remain these trade tensions, how countries react to the tariffs, and of course, the path of inflation.
So for you, the listener, what's the big picture takeaway here?
Well, it's a challenging mix, right? You've got risks to growth, particularly from trade friction, but also this stubborn inflation the Fed is fighting. For investors, it really underlines the need for diversification. And maybe thinking about what diversification means now, possibly assets that hedge inflation or companies less exposed to tariff impacts. Avoiding knee-jerk reactions to headlines is key.
Definitely. It feels like a real balancing act these days. You have decent earnings and resilience, but then these big clouds of trade and inflation hanging over everything. Choppy waters for sure.
It really is. Which leads to a final thought. In this world where you have both growth risks and persistent inflation, how do you start thinking differently about what a truly safe investment actually looks like? The definition might be changing.
Enjoy the brief? Please like and subscribe. From equities and bonds to global risk sentiment, we deliver day's key market moves, macro trends, and institutional flows in just 5 minutes. Live stream coming soon. Stay tuned.